Hi, I'm Debra Rudd. Welcome to the Hodge & Law PC International Tax Lunch. We do this almost every month on the last Friday of the month, noon Pacific time. Listen in online or watch the show later on YouTube. This month's topic is Preparing an Expatriation Income Tax Return in Form 8854. I'm going to provide a practical overview of how to approach an expatriation year tax return. It's not merely a matter of including a Form 8854 with the normal tax return. You usually also end up with a dual status tax return, some other extra pages. It's also a good idea to have a good general understanding of expatriation concepts, key dates during the year of expatriation, both the resident and non-resident tax rules, and a wide range of international tax forms and concepts. Let's get started. The topics I'm going to cover today are an overview of the expatriation rules, the general framework of what an expatriation tax return looks like, things that ideally should happen before preparing the expatriation year tax return, key dates during the year of expatriation, and then some practical tips and guidelines for information gathering and organization, preparing the forms, and filing the expatriation year tax return. First, an overview of expatriation. For the expatriation rules to apply, you have to have the right type of person, either a citizen or a long-term resident of the United States, and we'll talk about what long-term resident means in a minute, plus the right type of event, an expatriation event. And if you have those two things, then Section 877 Cap A applies and you're an expatriate. Then you have to check if you're subject to exit tax, and there's 3 financial tests for covered expatriate status. If you pass all 3 of those tests, then you're just a plain regular expatriate or a non-covered expatriate, and you don't have to pay exit tax. If you fail any one of those 3 tests, then you are a covered expatriate and you're paying exit tax. But only citizens and what's called a long-term resident need to worry about these rules. Any other type of status, and you can't be an expatriate. Citizens of the United States. Typically, you know if you're a citizen, and if you don't know, you should talk to an immigration lawyer. Long-term resident is a special term that means a green card holder who's had the status of lawful permanent resident in 8 of the last 15 years. Note the use of the word in rather than for. That means that we're only looking at whether they had their green card for any time period at all during the year. So it could be even one day during the year, and that year is going to count towards the long-term resident test. So for example, someone gets their green card on December 31st, 2017. That counts as 1 year. They hold their green card all these years, all the way through January 1st, 2024. And in this example, you've got someone who had their green card for 6 years and 2 days, and in that time period, they were able to meet the 8-year test. Now, when you're looking at this 8-year test, you do not need to count a year if you're able to make the treaty election to be taxed as a non-resident alien for the entire calendar year. Obviously, if you can't make the election for the entire calendar year, then some portion of the year the treaty is not going to apply to, and that's going to count as a year towards the 8-year test. So this is the same example as before, except in this scenario, the person was able to make a treaty election in 2019, so in 2024, they're only on year 7 instead of year 8. So in theory, you could toggle this status on and off using treaty elections. Of course, you have to be eligible to make the treaty election in order to do that. So you're a citizen or a long-term resident, and then you have an expatriation event that's going to make you an expatriate. What's an expatriation event? For citizens, this means terminating your citizenship by filing Form DS 4079 and taking an oath of renunciation. For long-term residents, this means terminating your green card by filing Form I-407 and turning in your physical green card along with that form. Note that letting your green card expire is not an act of expatriation. You still remain a U.S. taxpayer. And if you already have become a long-term resident, meaning you've already met the 8-year test, and then you make a treaty election, that is not going to toggle your status for that year. That is actually an act of expatriation. So if you're using treaty elections, proceed with caution. So now that you know you're an expatriate, you have to look at the 3 financial tests for covered expatriate status. As I mentioned before, you only need to fail one of these tests to be a covered expatriate. So if your net worth is $2 million or more, you're a covered expatriate. If your tax liability test, your average tax liability for the 5 years ending before expatriation is $201,000 or more, you're a covered expatriate. And that amount gets indexed for inflation, so it changes every year. And then lastly, the certification test. If you did not comply with all your tax obligations for the 5 years before the expatriation year, then you're a covered expatriate. Here is a handy little flowchart to show how to apply the tests, and there's also some exceptions to the tests as well. So the order that I suggest approaching this in is first looking at the certification test, because there are no exceptions to the certification test. If you fail this test, you're a covered expatriate. So first step when you're planning for expatriation is make sure you meet the certification test. Next, we look at the exceptions that might apply and the other tests. So if you are a dual citizen at birth, or you're 18 and a half or younger at the time that you expatriate, then you don't have to worry about the net worth test or the tax liability test. You can skip right over those, and as long as you meet the certification test, you can avoid covered expatriate status. Let's say neither of those exceptions applies to you, then you have to apply the net worth test and the tax liability test. It doesn't really matter which order you do those in, because either way, either you met one of the exceptions or you didn't. So if your net worth, again, is below $2 million, proceed to the tax liability test. If your average income tax liability is under $201,000, great, you're just an expatriate, you've met all 3 tests, and you don't have to pay exit tax. But if you failed either the net worth test or tax liability test or certification test, you're a covered expatriate. And this is what those 3 tests and the exceptions look like on Form 8854. Line 1 of Part 2, Section A is the tax liability test. Line 2 is the net worth test. Line 3 is something else we're going to talk about a little bit later. And then lines 4, 5, and 6 cover the 2 exceptions, the dual citizen at birth or under age 18 and a half when you expatriated. And then line 7 is the certification test. So you go through this decision tree. You're a citizen or a long-term resident. You have an expatriation event. You become an expatriate. You look at the 3 tests, and if you fail any one of them, you're a covered expatriate. You're paying exit tax. If you pass all 3, or if an exception applies, you're merely a regular expatriate. You don't have to pay exit tax. If you are paying exit tax, then there's a few different types of exit tax that you need to be aware of. For specified tax-deferred accounts, this is things like IRAs, you have a deemed distribution of the full account value. For deferred compensation, there's 2 types. Either you have ineligible, and that's taxed as a deemed present value lump sum distribution, or you have eligible deferred compensation, and that has 30% withheld from distributions as you take them. Another exit tax applies to trust distributions. There's 30% withheld from the taxable portion of the trust distributions when paid. And then for everything else, there is a deemed sale and a gain or loss recognized as if you actually sold it. For the first $866,000 of gains, those are excluded from income, and that's $866,000 of deemed sale gains, not all your gains for the year. And that's another number that changes every year, indexed for inflation. So that's the general idea of expatriation. Let's take a look at the framework that we're working with for an expatriation year tax return. What we're dealing with here is a transition year. Usually it's going to be a dual status tax year. Part of the year you're a resident, you have an expatriation event, you also have a termination of your U.S. resident, which is separate from your expatriation event. It could end up being the same day, or it might be a different day, and we'll talk about those rules. Then at the end of the year, you're a non-resident. Now, human individuals cannot file part-year returns in the United States. You have to file a return covering the entire calendar year. So that's why you typically end up with a dual status tax year, showing part of the year as a resident, part of the year as a non-resident, and then you tack on some paperwork to show information about the expatriation event. That's the 8854, and the residency termination. There's also some paperwork required to show the residency termination date. So because you have these different dates that apply, the expatriation date, the residency termination date, the first thing you want to do when you're preparing one of these returns is figure out what those dates are, because everything flows from knowing those dates. For the expatriation date, you have to prepare a personal, quote, balance sheet as of the expatriation date for the net worth test. You also have to calculate exit tax as of the day before the expatriation date. For the residency termination date, that date is important because that's the dividing line between being a U.S. resident and a U.S. non-resident. Note that the expatriation date is kind of irrelevant for the dividing line between residency and non-residency. You really only look at the residency termination date for that. And when you're lucky, the expatriation date and the residency termination date happen to be the same day, and it's a little bit easier to prepare the tax return in that situation. So after you've figured out what dates apply, then you're going to want to collect your information. For the expatriation date, you're going to need a list of all the assets, along with basis and holding period information, as well as a list of liabilities. That'll allow you to calculate net worth, and that information is also required to be reported on page 2 of Form 8854. For the residency termination date, you can use your U.S. resident taxpayer questionnaire for the period from January 1 to the residency termination date, and for the residency termination date to December 31, you can use your U.S. non-resident taxpayer questionnaire when you're gathering information. So you're kind of having your client fill out two different questionnaires as if they were two different tax years, just kind of smashed together into one. Next thing you do is organize the information. So for the balance sheet, you need to categorize the assets and liabilities to fit into the Form 8854 balance sheet. It's kind of a weird format. It's not really what you would normally think of as a balance sheet. We'll take a look at that later. For exit tax, you need to list out every single asset subject to the deemed sale or other type of exit tax, along with the relevant information. So one thing I notice here a lot is that people tend to skip over this and try to do this. For example, if they have a brokerage account, they try to do it using the total account basis and fair market value. But you really do need to list out every single asset in that account separately, and you do that for all your accounts. And generally for any asset you have that holds a bunch of assets inside it, typically you're going to be looking through to the assets inside, except for certain situations. There's always exceptions. Then for the dual status income tax, once you have your income information for the residency and non-resident portion of the year, you're going to create your work papers to show the pre- and post-residency termination income. Next, you're preparing the forms, or I should say lastly, you're preparing the forms. Usually, you're going to prepare a Form 1040 NR. That form is going to be called your dual status return. You'll include your Form 8854. We recommend putting in a dual status statement reconciliation. I'll show you what we use for that later on. And then lastly, at the end is a Form 1040, and that's referred to as the dual status statement. Now, when you're preparing an expatriation tax return, there are certain things that ideally should happen before you're actually preparing it. One of the things that a lot of people do is make pre-expatriation gifts. This is particularly popular with people whose net worth is a little over $2 million or $4 million or $6 million, and they can use the unified credit to reduce their assets without triggering any gift tax. So if someone wants to make a gift to reduce their net worth to get under $2 million, first of all, you want to make sure there's no foreign gift tax or transfer tax, but you also need to look at what U.S. gift tax rules apply to the gifts. And this is where the residency termination date for estate and gift tax purposes is going to matter. There are a couple ways you can avoid U.S. gift tax when you're giving away assets. For U.S. citizens and residents, you're typically going to be relying on the unified credit. Now, it's very, very important to note that this will not work for gifts given in the year of expatriation. You'll need to give the gifts in one year and expatriate in the following year. If you give the gifts in the same year that you expatriate, you're considered, for purposes of applying the unified credit, you look at your status on the last day of the year. You expatriated during the year, therefore you're a non-resident on the last day of the year. Therefore, the unified credit does not apply to you. So even though you would have given the gift earlier in the year and expatriated later in the year, you look at the status on the last day of the year. So pre-planning this and making sure you get a head start is very important if you're a U.S. resident or citizen. For people who are non-citizen, non-residents, you are not eligible for the unified credit. However, that also means that a lot of assets are not even subject to U.S. gift tax in the first place, and you're free to give non-U.S. situs property or intangible U.S. property. You can avoid U.S. gift tax by giving those types of assets. And the last one, and probably the most common one I see people use, is the marital deduction. This works if the recipient spouse is a U.S. citizen, and it doesn't matter what the donor's residency status is. So U.S. resident or citizen, U.S. non-resident, doesn't matter. As long as the spouse is a U.S. citizen, you get the marital deduction. You can give whatever, wherever, whenever. If you're making pre-expatriation gifts, and this is where it's relevant to preparing the expatriation year tax return, you need to think about the paperwork requirements. There's a gift tax return required on Form 709 if you're relying on the unified credit. And this is where you would give yourself away if you were making a gift in the same year of expatriation and relying on the unified credit. So in the year of expatriation, ideally you don't want to be filing a Form 709 because if you are, probably means you're trying to rely on the unified credit. Another place that you'll have to report information about gifts is Form 8854. Up until 2023, a statement was required to report significant changes to assets and liabilities. This was required in the Form 8854 instructions, but there was no guidance on what significant changes to assets and liabilities means. There was a new draft Form 8854 published for 2024 on October 3rd, and it has a new line 3 in Part 2, Section A, where you have to check a yes or no box with some guidance on what to do. And this is what line 3 says. Have there been significant changes in your assets and liabilities for the 5 years ending before the date of your expatriation? See instructions. If yes, attach an explanation. And as I said, there's a little bit of guidance, so here's what the form instructions say. Check the yes box if there have been significant changes in your assets and liabilities during the 5 years preceding your expatriation date. If your net worth was $2 million or more at any point during the 5 years preceding your expatriation date, but was less than $2 million on your expatriation date, there have been significant changes in your assets and liabilities. You must attach a statement to Form 8854 that explains the changes. So this is the first time I've ever seen any guidance from the IRS explaining what significant changes to assets and liabilities means. If your net worth was $2 million before expatriation and then less than $2 million on your expatriation date, they want to know what you did to reduce your net worth. Now they give an example to get a little bit more specific. The example says, during the 5 years preceding her expatriation date, Maria's net worth exceeded $2 million. However, after Maria made a gift of real property to her child on October 31st, 2024, Maria's net worth decreased such that it was less than $2 million on her expatriation date. Maria reported the gift on a federal gift tax return. Maria must check the yes box. Maria must also attach a statement that explains that her net worth decreased because she made a gift of real property to her child on October 31st, 2024, and that she reported the gift on a federal gift tax return. So this is the first time I've ever seen the IRS specify that they want you to talk about gifts when you're talking about changes to your assets and liabilities. So particularly in the situation where someone is making a gift to reduce their net worth to below $2 million, it looks like the IRS specifically wants information about those situations on the Form 8854. Another thing to keep in mind, something that should happen before you're preparing the expatriation tax return, is estimated tax payments. And this is true for any tax year. Anyone who's a U.S. taxpayer needs to be looking at making estimated tax payments to avoid underpayment penalties. For the expatriation year, you make estimated payments according to the normal schedule. You include your exit tax as part of the total tax liability for the year. So when you're in the year that you're making your estimated payments, you want to already be calculating the exit tax. You include your exit tax, if applicable, in your estimated payment calculations. And it may be necessary or helpful to annualize estimated payments if needed to minimize underpayment penalties. For example, if you expatriate later in the year and you end up, your assets increase in value wildly before you do that, and for whatever reason you decide to go ahead with it anyway and you're going to pay the exit tax, you might need to use the annualized method to make sure that you can keep your underpayment penalties as low as possible. And then for U.S. states, you do not need to worry about exit tax, so you don't need to worry about including exit tax in the estimated payments. Extensions and due dates. An expatriate is a non-resident of the U.S. on December 31st of the expatriation year, typically, and we'll talk about residency dates in a little bit. The tax form for non-residents is Form 1040-NR, and the other forms like Form 1040, 8854, etc., those are all just attachments. So you're filing a Form 1040-NR. Form 1040-NR is due June 15th, and you can get a 6-month extension to December 15th. There is an exception if the taxpayer has U.S. salary income during the year, then they're set 2 months back to April 15th and October 15th. And so most expatriates are not going to have that, but we've certainly seen it a number of times, so it's not all that uncommon. For the tax payments, use the regular due dates for estimated payments, and then the balance of tax is due either April 15th or June 15th. Again, U.S. salary income, April 15th. If they didn't have U.S. salary income, June 15th. Another thing that should be considered before preparing the expatriation tax return is married couples with one or more expatriating spouses. It adds a little bit of complexity into the equation. Non-resident returns cannot be filed jointly, so all married couples must file separately in the year of one or more spouses' expatriations. If there are any post-expatriation U.S. tax filing requirements, then they must continue filing separately. That means it's a best practice to make estimated payments separately so you don't have to split them up. That can be kind of a pain. And you're going to want to file separate extensions as well. So, a lot of married couples plan to file jointly every year, and they forget in the year of expatriation that they need to file separate extensions and make payments separately. Another thing you want to consider well before preparing the expatriation tax return is community property rules. And if community property rules apply to the person expatriating, it's going to impact their balance sheet, their net worth calculations, and it's going to impact how you calculate their exit tax. Obviously, it's also going to impact income tax reporting for both spouses for that year. In a lot of cases, the expatriation year might be the first year filing separately because they had no reason to file separately up till that time. And if it's not their first year filing separately, keep in mind that the prior returns may have been wrong in some way, because a lot of times when spouses in community property jurisdictions file separately, they tend to kind of just move income around in various ways that's not necessarily consistent with the laws. And if you find this, you may have a certification test problem. And we'll talk about that a little bit more later on as well. Now, going into preparing the expatriation year tax return, you're going to want to know the dates that apply very well. I, a long time ago, kind of just jumped into preparing someone's expatriation year tax return, made a lot of assumptions along the way. Long story short, I ended up having to re-prepare the entire return just a couple weeks before it was due, and that experience has led me to always start with figuring out the dates prior to starting to even collect information for the return. So the first date that you care about is the expatriation date. Next, you need to know the residency termination date for income tax purposes. And when preparing the return, those are the main two dates you're going to need to know about. But also always keep in mind the residency termination date for estate and gift tax purposes, because as I already discussed earlier, that can be an issue when you're using the unified credit. You need to know if this person is going to have a problem because they made a gift in the year of expatriation and they think they're going to be relying on the unified credit. So, how do you know your expatriation date? For citizens, this is fairly clear. This is the date that you swear an oath of renunciation in front of a consular official, and you will get a piece of paper called a certificate of loss of nationality that confirms that date as your date of expatriation. For green card holders, this is a little less clear. For green card holders, the regulations say that your expatriation date is the date you filed I-407 and turned in your physical green card to USCIS. But what does filed mean? I'm actually not sure. How do you know your expatriation date when they don't explain what they mean by filed? So what I do, this is kind of a practical tip, I use the date that USCIS confirms receipt as the expatriation date. That's usually only a couple days after you send the I-407 and the physical green card. If you provide your email address on form I-407, they will email you when they receive it, so then you have your date. Several weeks to several months later, they'll process your I-407. I don't use the processing date as the expatriation date because the rule says when you filed your I-407, not when they processed it. And the first day that both you and USCIS agree that you filed the I-407 is the date that they say they receive it. So that's kind of my reasoning in using that date. Now, you know your expatriation date, but what's the residency termination date? And that's the rule that applies for dividing your tax year for income tax purposes into the residency and non-resident periods. The default residency termination date is December 31st, but you may be eligible to use an earlier termination date. And the rule for using the earlier termination date says that if you meet the substantial presence test, then your termination date is the last day you're physically present in the US. If you meet the green card test, it's the first day you're no longer a lawful permanent resident. And if you meet both tests in that year, then it's the later of those two dates. So looking at that, you could give up your green card on June 15th, but then you make a trip back to the US and you're there for the entire month of November. Then the last day you're physically present in the US in that year would be November 30th. So even though you gave up your green card June 15th, the residency termination date is going to be November 30th. And then also important to include that you must have a tax home in and a closer connection to a foreign country, and include a statement providing evidence of that to establish an earlier termination date with the tax return. So you have to have that foreign country connection in order to use the earlier termination date. You can apply an exception. There's a 10-day exception to the substantial presence test. So if you come back to the US for 4 days later in the year after giving up your green card, you may be able to exclude those 4 days, and your residency termination date might be the same as your date of expatriation. But you can't disregard any days that are part of a longer continuous period of presence. So let's say you give up the green card June 15th, the example I used before, and then you're in the US for the entire month of November. You can't exclude 10 days of the month of November because it's longer than the 10-day period. And also you have to include the disregarded days for purposes of applying the substantial presence test, even if they can be ignored for determining the residency termination date. So we just looked at the residency termination date for green card holders, and for US citizens, it's pretty similar. US citizens are always US residents for income tax purposes. And I think you can use an earlier termination date. The same rules apply for citizens as for green card holders by analogy. If you meet the substantial presence test, it's the last day you're physically present in the US. If you're a citizen, and that's obviously what we're talking about here, that's the first day you're no longer a citizen. So these rules would apply looking at the substantial presence test mainly in the situation where you were a citizen who met the substantial presence test, or you met both. In that case, you're going to look at the later of the two as your residency termination date. Most of the time, US citizens giving up their citizenship are not going to meet the substantial presence test. I've seen it a few times. Dual citizenship is a thing. So a US citizen could be living long-term in the US and then suddenly move out of the country and terminate their citizenship. And again, because we're applying these rules by analogy, basically the regulation says, treat citizens the same as residents for purposes of these rules and determining if a citizen is a resident. So I assume that a citizen would also need to have a tax home in and a closer connection to a foreign country and include a statement to establish earlier termination date with the tax return. Now, another thing to consider is the state residency termination date for the income tax return. Now, as I mentioned, states do not have exit tax. U.S. people generally move freely from state to state, and we're not paying exit tax every time we move to a different state. Basically, that's going to be the same whether you move to another state or another country. They're not going to assess an exit tax. Each state has its own rules to determine when state residency starts and ends. So make sure, if that happens in the expatriation year, if you're also terminating state residency, make sure to file the appropriate returns to show that state residency has ended. A lot of times this happened earlier than the year of expatriation, and sometimes it can actually happen after the year of expatriation, depending on the state laws. And then lastly, residency termination for estate and gift tax. We talked about this a little bit earlier when we were talking about things that should happen before preparing the expatriation year tax return. And this is relevant in the situation where people are making pre-expatriation gifts to reduce their net worth. Often the residency termination for gift tax is different from the residency termination for income tax purposes. There is a specific definition of resident here for gift tax purposes. And it says a resident is an individual who has his domicile in the United States at the time of the gift. For this purpose, the United States includes, the states and the District of Columbia, blah, 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 see section, blah, blah, blah. All other individuals are non-residents. A person acquires a domicile in a place by living there for even a brief period of time with no definite present intention of moving therefrom. Residents without the requisite intention to remain indefinitely will not constitute domicile, nor will intention to change domicile affect such a change unless accompanied by actual removal. So you can see just by looking at this that these rules are very different from the rules for resident status for income tax purposes. Looking at the substantial presence test or the green card test, those are very clear, explicit guidelines. This is much more a facts and circumstances test. And also notice that you could have a green card but be a non-resident for gift tax if you're living outside the U.S. with no intention to return to the U.S., which is typically the case for someone who's about to expatriate. Okay, So we've talked about the very important dates, your residency termination date, your expatriation date. Hopefully those concepts are clear at this point. Now we're going to go on to talking about information gathering and organization. And at this stage, this is where you have to convince your client to give you what you need. So the more clearly and succinctly you can explain this to your client up front, the more smoothly this will go. So I find the more I can kind of educate my clients on how this all works, the more happy they are to provide everything I need in a timely way, and we can get their returns done much more smoothly. So when you're gathering the information for the Form 8854 balance sheet, you're going to want to get a list of all the client's assets: bank accounts, brokerage accounts, retirement accounts, pensions, real estate, businesses, trusts, personal assets, other assets. And you start with this big list of all these items, and then for things like brokerage accounts, you're going to want to know what's everything inside the account, and you also need the fair market value of each separate thing inside the account and its basis and its holding period, because you're going to have to pretend that you sold each separate thing. Now, when you're looking at this, notice 97-19 has the rules for how to apply the net worth test. It says that you own anything that would be taxable as a gift if you gave it away just before expatriation. And Form 8854 balance sheet, the total at the bottom should equal the net worth that you report on page 1 of Form 8854. A very, very frequent question is, are appraisals needed? They are not needed for purposes of expatriation. It's not like filing an estate tax return where you have to attach appraisals. But in some situations, it's a good idea, situations where the IRS might be likely to challenge the value of the asset that you report, or you think that, maybe it's closely held company, private company stock, and the value might not be obvious just from looking at the balance sheet. Maybe there's other factors that create an increase or a decrease in value, so you might want to have an appraisal in your file just in case you get audited. So when you're organizing the information for the balance sheet, you have to do some categorization. So like, let's say you have a brokerage account that you're looking at. You need to separate out the cash balances from the stocks, even though they're in the same account, because you have to report cash on one line and securities on another. And then further, you have to split stocks and securities into U.S. and foreign, marketable and non-marketable. I assume marketable just means it's traded on a market, and non-marketable means it's not. There's other categories that also split into U.S. and foreign. And there's some types of assets that require statement attachments, such as CFCs, partnerships, trusts, and other assets. And it's a good idea to familiarize with those assets and request that statement information early on in the process with your client, because sometimes it can take a while for them to get that information. So here's a snippet of the Form 8854 balance sheet on Form 8854. If this is blurry because of the webcast that we're doing, go ahead and Google Form 8854, pull up a copy of the form. This is on page 2 of that form. You'll see the exact same thing there. And the thing I wanted to point out here is look at lines 2 and 3, 4 and 5. This is where they have you split up your stock and securities into U.S. and foreign, and marketable and non-marketable. And then further on, if you read through the other lines, there's other things that you have to split up in the same way as well: intangibles, loans, real property, business property, etc. So when you're thinking about gathering your information, make sure to ask your client questions that will give you the information that you need to split everything into these categories. All right, now when you're gathering information for exit tax items, it's important to understand which assets are subject to the deemed sale and which are subject to other exit tax rules. For example, if someone has a taxable brokerage account, that's going to be subject to the deemed sale rules. If they have an IRA, that's different. You don't need the same type of information to prepare the return as you do for the taxable brokerage. So you want to group them by type of exit tax when you're preparing your work papers. Look at deemed sale assets, eligible deferred compensation, ineligible deferred compensation, specified tax deferred accounts, non-grantor trust interests. Make sure you organize all of this so that you'll be able to put it in the right places on the 8854. And this all actually gets reported on page 3 of the Form 8854, all the various exit tax rules that apply, and also on whatever applicable parts of Form 1040 to report the income from this exit tax. So this is page 3 of the 8854. I didn't include the full thing. It kind of drops off at the bottom. There's actually totals at the bottoms of those columns on the form. Again, if this is blurry, pull up a Form 8854, scroll to page 3, and you'll see a little more clearly. Question 1A asks about eligible deferred compensation, 1B, ineligible deferred compensation, 1C, specified tax deferred account, and 1D, non-grantor trusts. Then on line 2, you have to list all the deemed sale property. So everything that ends up making it to the income tax return as an exit tax item also gets reported kind of in like a reconciliation right on this page on Form 8854. Now, next you're going to be working on information gathering for the income tax return. And my assumption here is that you know how to prepare a U.S. resident tax return on Form 1040, and you know how to prepare a U.S. non-resident tax return on Form 1040-NR. What you're going to do is basically prepare each of those for the 2 separate parts of the year, but the non-resident return, because that's the return you're filing for the year, is also going to have the income from the resident part of the year pulled onto it as well. So I'll go over that in more detail in a minute. You're going to use the residency termination date as the dividing line between the resident and non-resident portions of the year, and you gather information from your client as if you're preparing 2 different tax returns, since different income items get reported for residents versus non-residents. For example, sales of stocks are taxable to residents but not to non-residents. One thing to be aware of, clients might not have told their U.S. financial institutions that they became a non-resident, so they're going to get standard 1099s covering the entire tax year. You might have to kind of translate the information into the right format for non-resident reporting, and in my experience, a lot of times you just have to request monthly account statements to be able to correctly split all the transactions into the resident and non-resident time periods. So it could be a lot of manual information gathering, data entry, and organization in your work papers. Now let's talk about actually preparing the tax returns. So you're doing a dual status tax return. You have someone who's a resident for part of the year, non-resident for part of the year. And one question I've always kind of had is, if the residency termination date is the default date, because you only get the earlier termination date if you meet all the criteria for that, but if you default to December 31st, are you a non-resident for one day of the year, December 31st, or do you just prepare a regular Form 1040 for the year? The rule in the regulations, I don't think, makes this a lot clearer. It says an alien individual who's a United States resident during the current tax year, or during the current year, but who is not a U.S. resident at any time during the following calendar year, will cease to be a resident for tax purposes on the individual's residency termination date. So are you a non-resident on your termination date, or do you continue to be a resident through the termination date and then the next day you're a non-resident? I don't think this is super clear. If anyone is aware of anything that clarifies this, I would appreciate if you could point me in that direction, because I've always been a little uncertain about this. So in any case, I think there's practical benefits to either option. For the 1040, you don't have to prepare a whole extra return and attach them all together, but keep in mind the 1040 NR has a later due date. It's June 15th. So there are also practical benefits to consider preparing a 1040 NR just for one day of the year. In any case, this is all mostly theoretical. You don't always see this question, but it does come up fairly often, so it's an important one to think about. For the dual status tax return, note that there's no standard deduction and only limited itemized deductions. So here's a little guide to what we do for dual status returns. We create a resident tax return, Form 1040, in our tax software, and we enter all the income information from the resident portion of the year in that. Add in all the exit tax items for all types of exit tax to the resident return, because exit tax is deemed to have happened on the day before expatriation, so all that stuff goes on the resident return. We force itemized deductions in the software, prepare the FBAR, 8938, 8960, 8621, and 5471, all the normal information returns for a U.S. resident with foreign assets in the resident return file. Then we copy that entire file into a new client file in the tax software. We make this one a non-resident return. Then we add in the income information from the non-resident portion of the year, and you should now have a non-resident return that reports all the income from the resident portion of the year, all the exit tax items, and all the income from the non-resident portion of the year. That's what you want to have. You also separately have a resident return reporting income from only the resident portion of the year, which you're going to need as an attachment. So we create an attachment called the dual status reconciliation statement. You'll see that on the next page in a second, that you put between the 1040 NR and the 1040, and it should show a reconciliation of all the items for the resident period, the exit tax items in the non-resident period. Label all the pages from the 1040 NR dual status return, all the pages from the 1040 dual status statement, attach them together with Form 8854 and the dual status statement reconciliation in between. And this is that reconciliation statement that we use. So just a template we have in Excel, and then we print it out to a PDF and insert it into the tax return. And this shows income from different lines of the tax return and what portion of the year they apply to. And that way, if any questions come up from the IRS, we can just point them to this, and that actually ends up solving a lot of the questions that we receive. Keep in mind you're going to have to troubleshoot some issues. Probably your tax software will not cooperate perfectly. The 1040 NR might not allow the 2555, the 8960, 8938, etc. You might find other issues in your tax software that I don't have in mine. So I recommend using extreme attention to detail to check that everything gets pulled through and ultimately reported. And in some cases, you may need to get a little bit creative to make it all work. So we're talking about preparing the returns. Preparing the Form 8854, you have the page 1, identifying information, covered, non-covered, expatriate information, important dates. Page 2, balance sheet, we discussed that a little more previously. Page 3, exit tax items, discussed that more previously. Page 4, deferral of tax. You can defer exit tax. Personally, I've never done this, and I don't know anyone who has. It is possible, but it's kind of undesirable. You have to post some kind of security, and there's interest. So as soon as clients find out about that, they usually lose interest in doing it, and they agree to just pay the tax because it's better for them. And then lastly is page 5 is stuff that only matters for prior year expatriations. It's irrelevant to the year of expatriation, so you don't need to worry about it if you're doing an expatriation year tax return, and then the signature block for the form. One thing that's really important that I've seen come up more times than I can count over the years is last-minute certification test problems. You're preparing the current year return, you're going to have to look at the prior returns for certain items, carryovers, etc. You may happen to notice that something was done incorrectly, and if you see that, you can't unsee it. So you might have to talk to your client about the fact that maybe they failed the certification test. Certification test says, do you certify under penalties of perjury that you've complied with all your tax obligations for the 5 preceding tax years? And generally it's best not to say no on that test because you're kind of inviting all kinds of unwanted IRS attention. But obviously you can't say yes if it's not true. So in these situations, we usually talk to our clients about considering amending the prior year returns to fix issues. If they're little issues to fix, why not just do it? If they're big issues to fix, then they really need to do it. We also talk to them about disclosing details like if they pretty much meet the certification test, but there's one little thing that they're not sure about, maybe check the yes box and include a statement saying, I believe I meet the certification test and here's some extra information that I want to provide. I'm not a lawyer, but my understanding is generally you can avoid perjury accusations if you disclose everything. And so if you're a CPA preparing someone's return in this situation, you may want to consider getting a lawyer's opinion on the issue or, having your client get a lawyer's opinion on this issue. For state tax returns, there's nothing special about these for the expatriation year. They won't show exit tax. Many states do allow partial year resident returns, so you don't have dual status for states. Actually, I don't know of any states that require dual status. And then you have all the usual differences between federal tax laws and the tax laws of a particular state. Lastly, filing the expatriation year tax return. This is some practical guidelines to help your client get this done from outside the country. So you're going to have to file on paper. You cannot e-file for dual status tax returns. So that means you're going to need to complete everything at least 1 week before the deadline so your client can mail signature pages. I really like to aim for at least 2 weeks. What I do is I give them 2 PDF files. I give them a copy of the entire return exactly as I would file it, minus the signatures, and then a separate file that contains only the pages they need to sign. I have them print out that signature pages file, single-sided, have them sign each page and mail it back. Keep in mind that a lot of people use A4 paper outside the US, so you may want to have some A4 paper in your office so you can put everything together on the same size paper. You'll need to pre-print and assemble the return. I put in little flags for where to insert the signature pages. Then you get your signature pages in the mail from the client. Just replace those pages in the return you printed out. Make a scan of everything, the return, the envelope, certified mail slip, and the return receipt once you get it back, and save the scan as proof that you filed the return. Send it along to the applicable filing address with the IRS, along with payment, of course. So there's also a second signed copy of Form 8854 that has to go to a special address in the 8854 instructions. Do the same thing with creating a complete scan as if it's a separate filing, e-file the FBAR, then save the original certified mail slips and return receipts. Keep them forever. You don't have to keep them forever, but keep them as long as you'd normally keep paperwork for taxes. Give your client copies of the as mailed PDF files for their records. I like to do this so clients, if they get a notice, they can see exactly what we filed. And then lastly, state tax returns. These are usually e-filed regardless of how the federal return is filed. and follow applicable state rules for termination of residency, part-year returns, non-resident returns, etc. So this brings us to the end. Have our little disclaimer here, and I just want to say thank you to everybody for joining. The next session will be on November 22nd. The topic will be, what kind of trust is this? Foreign or domestic, grantor or non-grantor, and simple or complex. This session will be presented by Phil. If you're not already on the mailing list, please sign up to get the announcement details about upcoming International Tax Lunch topics and Q&A sessions. Go to hodgen.com to do this. If you're already on the mailing list, and you probably are because you're listening to this, please tell your friends. See you again next time. Bye.